Hello, everyone, and welcome to this Family Building Society podcast to discuss the vitally important later life lending sector. The past year has been an eventful one for the later life lending sector, as rising rates have led to lower than expected lending figures as affordability became more constrained. The latest figures from the Equity Release Council earlier this month show that overall later life lending came to 2.6 billion in 2023, a fall from 6.2 billion in 2022. The introduction of Consumer Duty, along with the FCA review identifying products of poor practice, also impacted the sector and put a focus on customer vulnerability, the importance of customer outcomes, and good advice. But there are green shoots in the sector, with pricing starting to improve, which will help fulfill pent-up demand, and new product features like hybrid lifetime mortgage deals helping open up underserved parts of the market. Today, our range of speakers will give insight into product choice and availability in the sector, the use of packages, the importance of the broker-lender relationship, and the all-encompassing Consumer Duty. I'm joined by Darren Deacon, Head of Intermediary Sales at Family Building Society, Edward Payne, Director of Clifton Mortgages, and Michael Craig, Managing Director at Brilliant Solutions. So to kick off, welcome everyone. I'll go to Darren first, just to kind of give a bit of a brief overview of what you're seeing at the moment as a lender in the later life lending space, and what products you think should be added to the broker's arsenal.
Well, thanks, Anna. Naturally, as a later life specialist, it's a key area of our lending. Now, last year we, as you pointed out there, equity release, lifetime mortgages took a hit, and that would have been down to a number of factors, but obviously rates being as they were actually led to that. Now, the later life market in itself, actually equity release and lifetime mortgage make up a small element of that market in total. In fact, there's over 20 billion in the over 55s later life lending market. So that 4 or 6 billion of its figures I've heard in equity release actually makes up a small portion of that 20 billion. So the way I see it is that we are hopefully moving into a new era where interest rates are a bit more stable. There's more confidence returning to the market. We had cost of living pressures throughout last year, and obviously high interest rates and rates increasing month on month. So I will say that, and I see that the market has plenty of opportunity. Yes, there are challenges, but there are always elements to it that we can move along with. The market itself is a growing market. The demographic of people in that age group is growing. I mean, I'll just throw a couple of stats to you. In 2020, the biggest population growth of any age range was between the ages of 57 and 72. And that is set to rise to the age ranges of 75 and 87 by 2030. So it just gives an indication that the need is there, that we are in an aging population, and these customers are going to be getting older, and they're going to be still needing borrowing requirements. So we see the future of later life lending as a very positive one.
Fantastic. Edward, I don't know if you want to add anything to that as a broker, kind of what are you seeing coming through? Has demand started to pick up, or are you kind of recommending different products than, like rather than just equity release or lifetime mortgages like Darren mentioned?
Yeah, there's certainly a broader range of products being recommended now. Partly that's down to necessity. Customer need is driving a lot of the inquiries that I see. Sometimes it's down to people needing to deal with issues arising from coming to the end of an interest-only mortgage. Sometimes clients I see are trying to do tax planning, IHT planning, or care planning. And a lot of the time clients I see, are trying to raise money for lifestyle purposes. Darren's absolutely right. This is such a broad demographic. I think I read the other day 48% of the adult population in the UK is over 50 now. And, within that, you've got people ranging from 50 right the way up into their 90s who still have a financial need. So their needs are going to be very different. And those needs are going to grow over the course of those, 30 or so years. So they'll need different products. So some of it's driven by demand and need. Some of it's also driven by competition. And we've kind of got almost continental drift in a way in the later life sector, because we've got the lifetime mortgage sector here. We've also got standard mortgage sector here that are now offering people mortgages maybe up to 80 or so, or in case of Family Building Society, up to 95 potentially on a repayment basis where it's affordable and prudent to do it. And then we've also got this sector of more specialist RIO, term interest only, and hybrid products coming through. All of it's got to be good for clients. And it's absolutely necessary because, these clients do still need support.
Michael, do you have anything to add to that from a kind of packaging perspective?
Yeah, so I'm going to put a slight spin on it. What we're seeing as a packager is, because the complex needs of clients are so much more complex now from a specialist perspective, we're seeing a lot of parents, a lot more parents now starting to fund deposits for son, daughter, granddaughter, grandson, whatever it may be. So instead of looking at a 95% mortgage in the specialist market where it's a bit more restrictive, mum, dad, nan, granddad are starting to put in 5-10% of their own money to bring them down to the 85s, the 80%. So what we're seeing is we're looking at two transactions. We're looking at the specialist mortgage for son and daughter, but we're then looking at the RIO type mortgage to bring that money out from mum and dad's property. So what we're seeing as a packager is two transactions. We're seeing that one transaction when mum and daughter want to buy, but mum and dad are helping. I think I was told last year the third biggest lender of money was the bank of mum and dad. And that is how we as a packager are seeing more brokers discussing the whole financial situation rather than just son and daughter. If you can get hold of 5-10 more percent, you're no longer paying this rate, you're paying that rate. And we've got so many more options from an 85% perspective to a 95 perspective. So that's what we're seeing as packagers. There's a lot more bank of mum and dad helping out son and daughter.
I think there was research from Legal in General that they call it the bank of family, precisely because it's not just parents and grandparents, it's also maybe godparents, or kind of, there is a wider group of people that are giving that intergenerational help. And I think that feeds in really nicely with Family Building Society, because that is one of your specialties. Are you kind of seeing that intergenerational kind of joint borrower, sole proprietor kind of element coming into the later life lending space, or are you seeing more crossover in that area?
Yeah, and we use intergenerational lending as a term every single day. All of the BDMs are out there having those type of conversations. I'll just back up what Mike said there. The bank of mum and dad, the bank of grandma and granddad as well now, and we see that the people in their later years, they want to be able to use their property for all types of scenarios, maybe to better their own lifestyles. As Ed said there, they want to do more, spend their property so they can enhance their own lifestyle, but also for inheritance tax purposes, and also to assist their own children and grandchildren on the property ladder. So yeah, joint borrower sole proprietor is a big area of ours. So not just as we are restricted to lending to the customer themselves in later life, we are looking at the bigger picture. So yeah, we've got a first-time buyer typically, and we know the pressures that they're facing in trying to save for deposit, trying to get a secure mortgage at 95% themselves, cost of living, etc. So they're looking to draw on the help from their wider family, either to help them on that mortgage application by throwing income into the mortgage deal as a joint borrower sole proprietor, or by using their property to raise equity to gift to their family member in order that they can then strike out on their own. So there's two aspects to that, but certainly joint borrower sole proprietor has moved very much into a sort of mainstream type of lending certainly from where it was when I think I was first talking about it 5 or 6 years ago. It's something that we talk about hourly. It is that common now as an inquiry.
Going back to joint borrower sole proprietor, I'm interested to get more of a kind of lender perspective. We've talked about a lot of different kinds of products, from equity release to JPSB and some other products. What are lenders looking for in customers? What are the things that brokers should be sure to flag to you guys to kind of make sure that an application can progress kind of efficiently, I suppose?
In the later life space, so we will lend up to age 95. So just to probably take that back a little bit strip that back a bit on your question, typically what we would get is a scenario where you've got a customer or a set of customers, let's say they're in their mid to late 60s, and they're with a high street lender trapped on interest only. And usually, they've got to the end of the term, and what would happen is that high street lender will turn around and say, right, yeah, well, you've got to the point where we can't extend this any further. We're not going to offer you a further product. And in actual fact, we want our money back. Now, they'll start leaning on these customers, and the customers are going to start running to these guys, Mike and Ed, and say, well, what are my options? What can I do? As they will see it, the only options they have as a customer is either to sell the property or potentially look at some form of lifetime equity release style mortgage. Now, if they're going to a mortgage advisor with that as their situation, the mortgage advisor can take a view of that, then not necessarily have to go down one of those paths and look at their non-earned income, which we are happy to take, as I say, all the way up to age 95. So theoretically, you could have a customer who's 68 years of age with a modest mortgage balance, and we could still be offering a 27-year term, even for a 68-year-old, all the way up to age 95. We could put that on a repayment mortgage, enabling the advisor to be given the advice, best advice, to be able to pay that mortgage down and give them the time and the term to pay that mortgage. So we'd be asking the brokers to investigate those passive incomes. So it will be a state pension, it will be a fixed pension, it could be rental income, it could be how they look at a pension pot, because we're fairly unique in the way we view a pension pot. In what we do is we take the value of a pension pot and we will give it a slight haircut. So we'll take 90% of its worth, and we can divide the term of the mortgage into that pension pot, and that will massively increase the theoretical affordability, in that the customers in theory could take that amount from their pension year on year, and we're happy to underwrite it in that way. So from our perspective as a lender, we'd be looking at the advisors to explore those options and maybe ask those questions, rather than automatically think, right, okay, you're too old for a mainstream lender. Your next step is to step into the lifetime mortgage style of lending.
I think that's a really great note to end this session of the podcast on.